Three reasons why you need gold and silver in the portfolio. One of the questions that comes to us very commonly from investors and our clients is how much gold and silver should we have in the portfolio, or should we have it at all? It's very interesting if you go back in history and look at data that gold and silver have actually been used since 3000 BC in Mesopotamian times, where gold was used for high value transactions and silver was used for everyday consumption in exchange of items. You have seen that traditionally gold has been one of those places which people flock to whenever there is uncertainty. Geopolitical events, for example, automatically trigger movement of money towards safe haven assets like gold. Actually, besides safe haven uses, gold and silver have other uses as well. Gold, for example, is most commonly used even for consumption, for things like jewelry, while silver has a lot more industrial applications. It's used in solar panels, electronics, automobiles, etc. And therefore you will realize that because silver has much more industrial usage, it tends to move much more with economic cycles. So here are three reasons why you should actually have gold and silver in the portfolio. Number one, very low correlation to equities. I think one of the important things around portfolio construction and diversification is to ensure that you have assets that don't behave in the same manner at the same time. For example, you would have seen that with the Ukrainian war and the Israel-Palestinian conflict, gold and silver have done much better than equities this year so far. Gold is up about 16%, silver is up about 25%, while the Nifty is up only about 4 or 5% as we speak in May. The second thing that you need to keep in mind is that there is definitely currency depreciation benefits that come to gold and silver. You'll typically find that gold does much better in rupee terms than in dollar terms because the rupee has tended to depreciate against the US dollar. So if you look at 5-year returns, for example, you will find that gold is up about 12% per annum in dollar terms, but it's up 17% per annum in rupee terms. This difference is coming because the rupee has depreciated against the US dollar. And therefore, if you're looking for a hedge against currency depreciation, gold could be one of those answers. Number three, lower interest rates help gold and silver. Traditionally, when interest rates are high, investors like fixed income assets because they get better returns in the form of interest and coupons. When interest rates come down, which is what the likely expectation is, that the Fed will start to reduce interest rates either later this year or maybe next year, you should expect that fixed income assets will become less attractive as interest rates fall. And that will cause money to move towards gold and silver. So all in all, gold and silver need to be parts of portfolios. You need to be very mindful though about the allocation you make. I think it's very tempting to allocate disproportionately at certain points, but it's a good idea to have 5 to 10% of your portfolio in gold only for the purpose of achieving diversification and balance in your portfolio.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of Basel and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory.